Good morning again. It's 11 o'clock and now we will talk about tax and your investments. We have death and taxes. That is a reality for every one of us. And I think many people don't take into account the tax implications on investments, and other people, they just focus on tax. They want to pay the least amount of tax possible, and that also has a massive impact on the investment returns. Of course, many people just look at the gross return they receive and not the net return after they have paid the taxman, and in South Africa it seems to be one of the most efficient government agencies. But to help me, Piet Nel, he's from Saica, he's a tax expert, South African Institute for Chartered Accountants, and Louis van Vuren, he's from Fisa, the Fiduciary Institute for South Africa, two absolute tax experts. Piet, I'm going to start with you. Let's just frame this discussion. How complex is the tax regime in South Africa, especially related to investments?
Ryk, I think the answer is it is quite complex. So it is not a simple thing. And maybe I can start by just sort of giving a framework and explain why I believe it is that complex. It is complex because your investment returns are not individually taxed. So in South Africa we have that this is income and it's treated together. So you have a pot. Everything goes into the pot and we calculate the tax on that. Other than dividends, where the dividends tax is levied on the dividend itself. So to just conceptually understand how we get to this tax, so we would take all our incomes, and that can be pensions, salaries, interest, etc. The gross amount is to be declared to SARS and as a starting point of the calculation. Certain amounts may qualify for an exemption. So as interest, we've got nominal amounts that are exempt from that. So you deduct that from the gross amount. You're entitled to make some deductions. If you have a rental property, you've got rental income, you can take a deduction from that. You get that, and then you get to a net taxable income from this investment, but then collectively they're all added together. Then to that, you add your capital gains. So where you have disposed of assets, you will, on a similar basis, have a gross receipt on the disposal. You'll be entitled to make the cost of acquiring that asset, and the capital gain is the resultant. You add all of that together, you apply an inclusion rate to that, and then this whole pot goes into, and you levy the tax on that, which starts at 18% up to 45%.
Yeah, in a nutshell, that is complex, and I think very few individuals can navigate that. Yeah. Louis, in preparation for this session, you sent me a slide which summarizes the tax environment and what you need to take into account. Now, many people will say investments, capital gains tax, dividend tax, tax on your interest you receive. And, you know, if you can take care of those, you're fine, but it's not. The list you sent me, capital gains tax, income tax at the top of the list, then donations tax, the Pension Funds Act as an impact, the Child Care Act, the estate duty you need to pay, the MSS Act. I don't even know what MSS stands for.
Maintenance of Surviving Spouses.
Okay, and the Matrimonial Property Act, the Common Law and other acts, and then VAT at the end. So it is complex, as we've now established. But if you're an investor, when do you need to start worrying about the tax implications, and when do you go and see your tax expert for the first time?
Yeah. Well, Ryk, I'm actually an estate planner, so in my view, all financial planning starts with estate planning, because if you don't structure things correctly from the beginning, you run a serious risk of falling foul of things that you didn't even know of. The reason
How often does that happen? Just to interject.
Often. The reason I sent you that slide is 30 odd years ago, when I started for the first time becoming aware of the process of estate planning, it was very simple. You had a 1 million free from estate duty, plus everything that goes to the surviving spouse on death. So it was quite simple to manage an estate in a way that you pay as little as possible by the way of estate duty, etc. But then came VAT. and if you were a VAT vendor, or if you were supposed to be a VAT vendor but wasn't, and you die, then all of a sudden there were all kinds of complications. Then in 2001 came capital gains tax, and all of a sudden the things that we did to avoid estate duty previously didn't make sense anymore because of these other influences pulling in different directions. And then obviously what you have to remember is all your investments form part of your estate. And if you're a South African resident, it doesn't matter where those investments are, they form part of your estate. And they come into play for estate duty purposes. Then your marital regime, how you are married, may play a role in some of the factors that you have to take into consideration when when planning your estate and looking out for ways to pay as little tax as possible. But the most important thing to my mind is you should never allow the tax tail to wag the planning dog. First, get your structures right, get your planning right, and to achieve what you want to do, what you want to achieve, and then start looking at how do you do that in the most tax efficient way. You can tie yourself in knots trying to save tax, and in the end pay a price, a different price in another place.
Opportunity cost.
Opportunity costs, the way that things aren't practically structured. If you just focus on tax. Sometimes tax is the price you pay to get what you want.
Now, in theory at least, the more tax you pay, the more revenue or income you've received.
Yeah.
And that's maybe one way to look at it. Piet, just where do you start? Do you start with your financial advisor, or isn't a financial advisor equipped, or the average financial advisor equipped to also handle the tax side of the investment portfolio and plan?
The financial advisors, to my recollection, is actually equipped. They have part of, when they write that entrance exam of theirs, they actually are examined on the tax matters as well. But I think you would probably start with your financial advisor, but I think this is a team's effort. So clearly, I'm a pure tax specialist, so I will not be able to give you any advice on structuring your, I will just tell you the tax consequences of that. So I would imagine that if the financial advisor, and if you're going into complex structures, then you must have a tax specialist as part of the team. So in all your estate duty plans, you cannot go into that without a tax advisor. Yeah.
Let's talk about a practical example. Let's take a practical example. Say somebody has a pretty significant share portfolio, equity portfolio, diversified, not across geographies, not only in South Africa but offshore. What are the main elements that individual needs to take into account? My immediate thought is capital gains tax, and make sure you don't trade too often to trigger a trading type of consequence, to let income be taxed at your income tax rate. What do you need to take into account?
Yeah, so do you want me to start? Yeah, okay. So you now have a person that has an existing portfolio, so you're not starting out afresh. So, and it's easy in his or her own personal name. So the things that you will take into account, of course, is the income that flows from this, the dividends income, or whatever income accrues on those shares. It would typically be dividends or foreign dividends, and the tax consequences of that. But then, absolutely right, you have to constantly monitor your portfolio to see that you are in shares that are still growing. And the moment that you change those portfolios, and this is what one must, those shares in your portfolio that you must take into account, it will have a capital gain consequence. There's also transaction taxes. I mean, there's a securities transfer tax on the acquisition and purchase of shares, and most often it's required from the person in whose name it is, but sometimes you'll have to pay that. So there's cost involved in doing that, and so to reposition your investment will have capital gain consequences. And then that question about about the regularity of the trading. So the principle in South Africa is the distinction between income and capital, which is taxed differently at lower rates, is that income is something that is derived from business activities. Investment activities per se would not be business activities, because business is you buy and sell things. So a person like, for instance, you wonder, and I'll take that now, but to the people that are doing arbitrage now in the Bitcoin or the cryptocurrency space, they're unlikely to be able to prove that they are an investor there. But a person that has a long-term commitment and are merely, looking at your portfolio and getting rid of shares that you don't want and buying better shares, will generally be able to, and even where they do that before the expiry of the 3-year period, which is an automatic capital intention on that, will normally be able to prove that they didn't have that speculative intent and that the income is then subject to capital gains.
The rule of thumb is within 3 years.
Within 3 years. On shares, we've got the rule of thumb, it's legislated that SARS will, even if you have acquired a share, I have this example of I bought a share and it's never come back to the place I paid for it, so, and I speculatively bought it, and now after 3 years it's capital. So that is the rule of thumb. It's 3 years, SARS said, then we don't dispute that it is a capital transaction.
But after 2 years and 364 days, there's not a grey area where you can sell a share and not pay capital gains and it's not being regarded as income.
Yeah. So, but you know, that is important. A lot of people are saying, we've got this in the capital gain space, you've got a part of your capital gain that's not taxed. So you have growth in a share, and you've got a 40,000 of your gain. That's nominal, but it may be, but just to make that principle. So they are selling before year end and maybe before their 3-year end to take account of a loss, so that I can set that loss off against my other income and not let it run over to the next period. And then if I want the share, then I buy it back, but I've now get the tax benefit of that. So there is, you can play that game. And there's some anti-avoidance rules there, but it generally is a good, you can do that. Yeah.
Play a game in a long-term investment portfolio. Viewers are welcome to send in questions. The email address events@moneyweb.co.za, or just type into the chat box on the YouTube channel. I see there are several questions that are coming through. So please keep those questions coming.
Can I just add on something on what Piet said is from a structuring point, from a planning point, what you have to be very careful of is if you start investing offshore, is to understand what the legal regime is with regard to succession in that jurisdiction. I'll give you an example. A lot of South Africans moved wealth off to Mauritius over the last number of years. Mauritius has French law, which has forced heirship rules, which means forced heirship rules, which
and
means
not only with respect to the house.
Which means that you cannot bequeath as you please, as we can do in South Africa in your will. You are forced to leave a certain portion to your spouse and to your children. So it's important to, before you start investing in a jurisdiction, to understand the law of succession rules in that jurisdiction, because it may be appropriate to not then invest in that jurisdiction in your own name, but to set up a structure through which you place your investment.
That's my next question, where, when do you start to structure your portfolio from having investments in your own name to looking at trusts, looking at companies? Is there a rule of thumb?
Any structure costs money. So the rule of thumb would be if your investment is not big enough to justify that cost, then the default would be invest in your own name. Except if you're in a jurisdiction where you don't want to be in your own name because of forced heirship rules, law of succession rules that apply to that specific jurisdiction. Just to come back to those rules, large parts of Europe has the same thing, the same rules. For instance, you shouldn't really, in France, you shouldn't buy fixed property in your own name because it will be subject to the forced heirship rules. There is a way out to an extent in that the Hague Convention on succession in Europe allows you to choose the law that you want to apply to your estate. So again, it's very complex, and you should get advice as soon as possible before you start doing anything in a jurisdiction other than South Africa.
So if you buy a property in Mauritius or in France, do you do it in a South African company or through a South African company, or do you need to register a company in those jurisdictions?
I'm not an expert on French law or Mauritius law, but I would think you should get advice on that before you do anything of that kind. Get an expert in that jurisdiction who can advise you and assist you.
But I think the key point is it's expensive relative to the size of your portfolio. So if you have a massive 100 million plus portfolio, that's the way to go. But if you have 1, 2, 3, 4 million, it's still good to do it in your own name, and the tax implications won't exceed the admin cost of those structures.
I think the other thing with regard to death taxes, to estate duty as we call it in South Africa, or inheritance tax in the UK, is to be aware of the fact that there are double taxation agreements with some countries, and to also understand what that can do for you and how it can work in your favor. But the general rule is, if you're a South African resident, everything you own, doesn't matter where it is, falls into your estate for estate duty, with a couple of exceptions. But we don't need to go into the technicalities of that.
Yeah, and I can appreciate it. To start early with estate planning forms part of your investment plan.
Yes.
For example, if you have fixed property, to transfer a property from your own name into a trust, that is very, very expensive, and there's a lot of taxes to be paid in that process. But let's talk about trusts quickly as a vehicle for to not avoid tax, but to as a tax structuring mechanism. How relevant is it? Has SARS plugged all the holes?
I'll start, and then we'll give the trust specialist an opportunity to do that. Ryk, I think that, and this question was asked to me once when I presented to the Standing Committee on Finance, when Section 7 Cap C was introduced. There definitely still is a need for a trust. I am personally in favor of. I would always use that. It would be part of my plan. My general structure would be have the trust and a company underneath that. The trust, and in fact, we need, and we're lobbying to get some of the law amended there. It is paying tax at 45%, capital gains inclusion at 80%. So it is, from a tax point of view, a really expensive vehicle. But the ability to, on that conduit principle, which is now codified into law, the ability to transfer the income that accrues to the trust to the beneficiaries that may have lower tax rates sort of addresses that problems that we've had in the past. But we've had the discussion before. It still is part of the structure, any estate plan. In the past, I used to say if you're looking at a person that's got an estate of about 7 million plus, you would start considering the trust because of the cost that Louis had said. But then if I have a client that starts out a business and you've got this phenomenal good idea, I would earlier rather than later then bring it into a trust structure. If I have that existing portfolio which I have with me, then it's costly to transfer it into the trust and things like that. But when I start out with something that potentially will grow phenomenally, and I mean, I've got an example of a person that started out initial capital that funded the company through the trust was some 1,000 rand. It now sits at a billion rand worth. Now that is completely outside of your estate. So there it makes sense, and the cost up front was nominal compared to the benefit we had from that. But Louis, I'd rather hear your view.
Ryk, I did a bit of modelling recently on Section 7 capital C of the Income Tax Act, which deems interest foregone on a loan to a trust or to a company where a trust holds the shares in that company. That interest foregone on an interest-free loan is deemed a donation every year on the last day of the tax year, and is then subject to donations tax. And as Piet said, if you have a phenomenal business idea and you expect exponential growth in a new business, then it still makes sense to use the old structure of you make a loan to the trust channels that loan into the startup business, but the trust holds all the shares in the company. The modeling I did is on a loan of 50 million. Well, I did it from 1 million to 50 million, but it boils down to an estate duty saving over 20 years of in the region of 8 million. On the basis of our current official interest rate, and with a growth rate of only 5.5% per annum on the value of that business. Now, the higher that growth rate in the business is, the more it makes sense to use such a structure, to get that huge value out of your estate for estate duty purposes. What one has to be careful of, and what you have to take expert advice on before you start something like this, is because those shares are held in the trust and those shares increase in value, you will have a capital gains tax implication in that trust. But as Piet said, there is the conduit principle available in trusts where you can attribute a capital gain to a beneficiary who then gets taxed in his or her own hands on that capital gain. It's not a panacea for everything, but it is available, and in certain circumstances it may make sense.
Would that be a better option than to say to create a company to hold all the investments? Is that a better option, or how does it compare to a trust?
Yeah, you have to be careful. I think what you have to understand about a company is that you can get money out of a company in two ways. You can either draw a salary from the company if you are employed by that company, or the company has to declare a profit, pay corporate tax,
And dividend tax.
pay dividend withholding tax to get the value or the income out of the company. So that question is a question that can only be answered by looking at the specific circumstances, to my mind, by a tax expert, working with a structuring expert.
Maybe if I can, and that will probably answer, because I don't think everybody would know what Section 7C is. So it's tax related, and that doesn't make it, incomprehensible. But the principle we have here in tax planning, and this is why you've been asking this question and why you want to put it in a trust or a company, and then we can answer which one is the better. Is I'm now starting out in this investment scheme. I'm a young person. I'm starting investing, and my portfolio grows. What happens when I die is that you started with death and taxes. There's SARS's last chance to take its taxes. So it's, colloquially speaking, it comes from Benjamin Franklin as well, though he made it in the context of the Constitution then. So we are saying, I've built up this investment over time, and when I die, I have a capital gain and an estate duty. So what we want to do is to address that capital gain, because that has a liability that is brought against the estate at death, and the estate duty. So we transfer this growth asset at its current market value to the trust or the company, but let's just say, so we transfer it, we get it out of our own name. Now, we always say that donation, or I say that donations tax and estate duty is, donations tax is just estate duty paid up front. So if you want to get rid of an asset, you donate it. Then you pay your 20% and then you've got no problem at the end. But we don't want to pay that tax. So we transfer it on loan account, and this is where your 7C comes in. So we transfer the asset, now it grows. So let's say I had an asset that's worth R1 million now. I transfer it on loan account to the trust. 30 years later, when I die, it's worth 20 million rand. Then the only asset in my estate is this loan account. And I'm taxed at that. So I pay 200,000 tax, whereas I should have paid 20 million rand worth of tax. Now, if I do that same, well, by having done that, the asset and everything happens in the trust. If I transfer it to a company, either in return of shares or by way of a loan account, but I would generally do that and take the shares in the company, because I can do that, it's a tax-free transfer. Then all I've done is replaced my growth asset with shares which essentially have that growth asset. So it remains in my name, that growth is taxed in my name, and ultimately when I die, that is the value that will be included. So you understand the difference there.
Yeah, that's complicated, and I think it will differ from individual to individual. Circumstances will also dictate exactly how you approach it. Interesting question here regarding offshore investments. Is the tax payable on investments owned directly offshore? That means you open an account at BlackRock, for example, you have investments there and you get returns. Is that taxed differently to the investments in local feeder funds, which have exposure to the same international assets?
Yeah.
So if you're international, if you put your money in offshore, you take it out of South Africa, is that income taxed differently to while you keep it in South Africa?
So is the feeder fund similar to collective investment schemes?
So collective investment schemes, and you just invest in rands, and then the asset manager invests.
It's rand denominated.
It's rand denominated.
Yeah. Then it's not much different. There's a difference in the tax on a dividend. A dividend is a dividend declared by a South African resident company and paid to the investor, and a foreign dividend. So, but essentially they come down to the same tax percentage. So no, there's no difference in those. It's also, in a collective investment scheme, you are not affected as the participation holder in movements if they buy and sell shares. It's only when you exit that you will then calculate a capital gain on the difference between what you've paid for it and what you've earned. But the income substantially taxed the same as South African funds. Yeah.
If you have your money offshore, would you be say you're invested in the United States, would you be taxed in the United States?
So yes, and this is where Louis had referred to the double taxation treaty. So the moment you've got this, so in tax we talk about you've got a South African resident, or you've got a resident of one country for tax purposes, and then you've got income in another company, so in another country. So you've got this cross-border transaction. Then both countries will generally have a right to tax, but the double taxation treaties will, America, I can't offhand recall that, but I think it's like that. You will often have a sole taxing right, or you will have a limited taxing right. So our dividends tax is at 20%. If I invest in, let's say, the Netherlands, and I have more than 25%, 10% interest in that company there, then the withholding tax in the Netherlands is 10%, and South Africa will tax me on the balance. So there's a dual tax. So it becomes very complex, and it applies to interest and royalties as well. So,
And this following question links to, is also relevant. Does US estate law apply to my New York Stock Exchange stocks and ETFs that I buy on Easy Equities, which is a local investment platform?
I'm not an expert on US law, but the same would apply if you're a South African resident. That would form part of your estate in South Africa for estate duty purposes. But whatever is taxed in the US will then be regarded as a credit in your South African estate duty liability on death. Whatever you have to pay there, and I don't know, I'm not an expert on American inheritance taxes and so on, but whatever is paid there will rank as a credit for your estate duty liability in South Africa.
But there will definitely be a double tax, particularly with the shares. And there's a lot of South Africans that are now structuring exactly for that for the last couple of years. They call it a citus tax. So it's where it is situated that they have the right to tax that.
But how complicated is that administration process? Do you need now to submit the return to the US government as well as the South African?
So, yeah, it becomes really complex. The moment, and I think that is why that's one of the benefits of using a trust or a company to make your foreign investments, because of that admin. It's exactly that.
Yeah, that can be
the complexity depends on the jurisdiction. In some jurisdictions, upon death, in some jurisdictions you will find it hard to deal with those assets without an executor in that country or an agent of a South African executor acting in that country. And the paperwork to, for instance, sell fixed property in the UK in a South African deceased estate with only a South African will can be quite cumbersome.
Yeah, I think that's a discussion for a different day. Yeah. But yes, every jurisdiction you need to ensure that you have a will, because it's not always compatible. I want to talk about cash flow, because many people invest heavily in equities. I see cash as not being one of the optimal asset classes, especially when you include long-term, you have a long-term strategy. But upon death, or maybe some emergency hits, you need to liquidate assets, or for example, when somebody dies, you don't want to sell an asset to pay tax, especially a home and the like. How good are South Africans in planning cash flow for such an unforeseen event?
Terribly poor. Anything between a third and a half of all South African estates of any deceased estates of any value has a liquidity shortage of some magnitude. It's one of those things that it's probably the most important contributor, apart from Master's Office service levels. It's the most important contributor to delaying the administration process of a deceased estate, is if there is insufficient cash. On the other hand, you don't want too much cash in the estate. If things like life insurance and so on can pay outside the estate, because then you save on executors' fees, but don't overdo it, because that saving could very quickly disappear due to the delays if there's insufficient cash in the estate. So it's very important to ensure that there is sufficient cash.
Yeah, there are also other, especially with capital gains tax, you can be liable for a capital gains tax without actually receiving cash proceeds from an investment. Yes. And for example, if you have a fixed deposit that only pays out in year 5, you will have a interest liability every year up until year 5, and you will need to finance that with cash from other sources.
Correct, yeah. So Ryk, I think a lot of people, investors, and we just take when was ABN InDev and your process transaction. So you have this. You're not actually exiting the company, but you're exchanging one share for another share. So we would think as an investor, but I haven't received anything. I didn't actually sell my asset. I just rolled it over into a new investment. But yes, it is a disposal, and your capital gain was realized up until that date, and you've got a capital gain transaction. So there are many instances like that where you have a reinvestment, and that reinvestment. So all your restructuring of the portfolio, as I've said, has a capital gain consequence, and a lot of people miss that. And I've seen that where people are in collective investment schemes were just advised to move from the one managed fund to the other, And then at the end of the year, because SARS now receives these reporting from them as third parties, you just get, an uncle of mine, he just got a 400,000 tax bill. And I said, where does this come from? I said, well, you made a capital gain. And he said, but I didn't take money out. So that's exactly that. And we also have this, you know, when you capitalize income, so when you go into your collective investment schemes, your interest and dividends are capitalized into that scheme. You haven't received that, but you're still paying tax on that income. So the same principle.
How lenient is SARS when somebody really has a cash flow problem and it comes from a lack of planning, or is it, listen, pay up all?
And unfortunately, they've got a constitutional court behind them. They have this task to collect money. So in my experience, they're not very lenient. So, you know, let's not go into the tax administration side of things, but particularly in the States, you know, you've got, and this is why the planning is so essential there. You've got this capital gains, and as Louis had said, which we didn't have, you know, 20 years. Capital gains is now with us since 1 October 2001. We didn't have that. Now you've got a deemed disposal where there's no actual cash realized from the deceased to his estate. And you must pay that capital gains and then the estate duty. And they have no leniency on that. In fact, you must pay the estate duty within 12 months. Otherwise, they start turning interest on that.
The other sneaky thing about capital gains tax at death is that if you're a sole proprietor of a business or a farmer, then your stock in trade is basically deemed income or immediately. And that has a potential.
What do you mean by that?
Your livestock as a farmer.
As a farmer. There's an immediate cash drain on the deceased estate. If you have an investment portfolio that does not go to the surviving spouse, the capital gain between your base cost and the value at date of death will trigger capital gains tax, which will then cause an additional extra drain on the cash resources in the estate. So what you don't want to do is you don't want to be in a position to start selling your investments, or you don't want to put your executor in the position, you won't be there, but you don't want to put your executor in the position where he or she will have to start selling your investments to pay capital gains tax, because selling those investments might trigger a further capital gains tax, because your deceased estate is a separate taxpayer, and any increase in value between date of death and date of sale will cause a further capital gain in the estate.
I'm feeling like I'm going to see my professional shortly after this session. There are a few questions regarding donations and, for example, owning a property with someone else. So you have a property and it's in two names. It happens when you can't afford the bond on your own. What are the implications there? Let's start with property where it's two people joint ownership, and there's a divorce, and the ownership then moves to one party.
I can start with that. So the joint ownership, and it's particularly prevalent in your marriages or in your permanent relationships, which you are treated as spouses. Any transfer of ownership or full ownership between spouses on a divorce is tax neutral from an estate duty point of view, from a normal tax point of view. So there's no capital gain, and also from a transfer duty point of view. But that's only where we have spouses. So when you jointly own, you actually have a partnership with regard to the property. And there are some disputes about, people often say, but I share 60-40 or because I pay the bond and you just pay this. But generally that must be by agreement. So when you jointly own property, you must understand that this is a partnership. The income accrues to the partners jointly. The expenses are incurred by them. They have the tax jointly, and the capital gain When you exit the partnership, you're disposing of a part of your interest in that asset, and there will be capital gain on that, and then no rollover. So, but between spouses, we have this, so at death or on divorce, that we have a rollover of the capital gains there. But you asked the donations tax. I don't know, was that?
You shouldn't buy a property a couple shouldn't buy property in both their names for romantic reasons. You need to make sure that the tax benefit.
It depends on which spouse you ask that question. But I would tend to agree with you. But this is what it's so complicated with the maintenance of surviving spouse, but also your Section 7. So you're in divorce, there's a maintenance obligation also that passes over that is created on divorce. So and then it helps if the house is then in both spouses. So if you're married in community property, you have this partnership from day one and jointly own the property.
Let's talk about donations tax. How does it work?
Donations tax is basically you pay 20% tax on the donation that exceeds 100,000 Rand per taxpayer per annum. So you can donate up to 100,000 free from donations tax every tax year. After that...
to one individual or to all individuals?
To all individuals. Yeah, it's per taxpayer, there's 100,000.
Yeah, cumulative 100,000.
And after that you pay 20% on the value of the donation on date of donation, the value on the date of donation.
And the beneficiary, does the beneficiary pay tax on the income?
No. Well, SARS can collect it from the beneficiary if the donor does not pay the tax within, the end of the month that follows on the month in which the donation was made.
30 days after the effective date of the donation. But it's not only 20%, Louis. So if you donate more than 30 million Rand of cumulatively,
yes, of course.
Then we go into the 25%. So it's similar to a state duty. State duty up to 30 million Rand, 20%, and thereafter you've got a 25% rate of tax.
So I saw somebody the other day asking whether it wouldn't be a good idea to donate everything before you die. The problem is you don't know when you're going to die, or most people don't. I
need to ask it back.
There are two ways of actually dealing with something like that, and that is that you can donate where the rights to the donation vest in the beneficiary now, but will only become enforceable at death. But those donations are not subject to donations tax; they're subject to estate duty.
And in loans or donations to spouses, is that treated differently?
You can donate as much as you like to your spouse without any tax implications.
Yeah, so similar to what we said on the property. But if you're married under the accrual system, there's a little bit of thing. But any donations between spouses is not subject to donations tax. But the loan, so what's the context of the loan? So one spouse make a loan. Yeah. You typically you would want the one spouse to purchase property and the other spouse would then advance a loan. And then you may have interest or may not have interest. There's some tax avoidance there if you move income, but otherwise there's no problem with that.
If you move income to a spouse,
with a lower tax rate, then it effectively will bring that income back to the spouse. That is the higher tax rate job.
A lot of questions on foreign assets and revenue, especially property for interest. Like, do South Africans understand exactly the tax regime in other countries before they make the decisions? Because you get a lot of the adverts on Moneyweb and on other sites, and where they say, listen, go buy a property, you can get a golden visa, it's only going to cost you 5 million Rand, but those type of transactions and decisions also have significant tax implications.
Right. And I think that the quick answer is I don't think many South Africans understand that. And my experiences of South Africa, there's Africans that have now immigrated and live abroad and still retain property in South Africa. This is your one example where if I own property in London or wherever in the world, I will have to submit a tax return. So that's a trade income there. I'll have my rental income. I'll have to declare it. That country has the right to tax that capital gain. South Africa has a capital gain. So there's a dual taxing right in that properties. So that rental income is declared in both countries. And in the resident country, so South African resident will get a foreign tax credit, as Louis had said, alluded to previously, will get a foreign tax credit for the foreign taxes. So yeah.
Interesting question from Andre. If I want to buy a property for my child, is it better to register it in my name or in the child's name?
Well, if you register it in your name, it's not the child's property. We have property in South Africa. We have a very good property registration system in South Africa. So the registered owner on the title deed is the owner of the property, and nobody else has any claim.
But that's the legal perspective. Yeah. But what about, a family? You can't, there's a lifelong bond between you and a child. From a tax perspective, is it better or not?
But so maybe let's start first with the donations tax. And I'm sure Louis is burning to make that same comment. The moment I register that property in my child's name, then I don't own that. So I've now used, let's say I take a 2 million rand and buy a house for 2 million rand. Effectively, my estate is poorer by the 2 million rand. I've donated that. So buying it in his name or her name is a donation.
Yeah.
You achieve that, but that's a cost.
There is obviously a way to get around that donation, and that is Section 7 capital C that Piet referred to earlier only applies to trusts and companies where a trust holds the shares and the lender is a connected person with regard to that trust or that company. But you can extend a loan, an interest-free loan to your child, and buy the property in the child's name. And then donate 100,000 rand a year away towards that loan and reduce the loan that way. Because a loan between individuals where there is no trust involved does not trigger that deemed donation under Section 7 capital C. Because in our law, interest is not assumed. Interest has to be stipulated in an agreement, otherwise there is no interest.
We've got 5 minutes left. Retirement annuities, you get a big tax benefit if you contribute towards a retirement annuity. Another mechanism in the investment world is tax-free savings accounts, where you also do save on a lot of the taxes that are applicable if you compared to investing it through other means. What are your views on retirement annuities just from a tax perspective? Is it worth it?
If I may start, I think it definitely is worth it, and there's the two reasons. The first one is, as you've already alluded to, is that we have the ability to deduct against our other income our contributions into the retirement annuity. So effectively, revenue authorities are paying part of your contribution by giving you tax back on that. So if you contribute to the tax-free investment, you don't get a deduction for that. You just have tax-free. But then the additional reason for that is that your retirement annuities, and let's just talk about your retirement funds itself, any growth, any dividends that accrues to that, any capital gains made in that is not taxed. Whereas if you had directly invested into the similar products for your retirement age, you would have throughout your life paid that. And then there's no capital gains at the end. There's only a gain where you exit from the fund, which you're limited to take 1/3 of that, or on death you can maybe take more of that. But that's the beauty, and that's for me the biggest advantage of a retirement annuity, is that flexibility I have to convert that retirement annuity for the nominees, nominees in the context of the retirement fund, your beneficiaries. They can make certain tax-free elections. I can transfer that to the surviving spouse's retirement annuity fund without any tax consequences. So not only during the course of it, this upfront deduction, no tax on the growth, also benefits at the end. So for me, that's the top class investment.
Obviously, where SARS gets its due is when you retire from such a fund, then you have to buy a pension, an annuity with at least 2/3 of that. And that annuity will be fully taxable in your hands. But getting back to the tax-free investment, I think what you also have to be careful of is not to go into a tax-free investment, especially an interest-bearing tax-free investment. Do not go in there until you've used up your interest exemption on ordinary cash investments. So it doesn't make sense, because then you lose that exemption. So first make sure.
What is that exemption? 44,000?
23,800.
And 34,500 for people over 65. Yeah. So this is absolutely critical. A very good way to think about this. So when I decide to go into tax-free investment, and I don't have, what are we looking at, 600,000 now, roughly, that will give interest at the rate that we were looking at it now, which will be tax-free. So if I have cash of less than 600,000 Rand, then I will not go into a tax-free investment in a cash one. I will go into a share investment, because the dividends then becomes tax-free. Whereas if I directly own that dividend, I will pay 20% tax on the dividend. So, and then your accumulative growth is net of the 20% tax, where in my own name it would not be. Yeah. So, yeah.
The only negative, I think, of the tax-free savings account is it's capped. And the annual contributions, I think it's limited at 36,000.
Yeah, so 36,000 with an overall 500,000 limit, so which we're still far away from, but and it should not be capped, I agree.
And it's a once and for all cap that. You can't, when you withdraw, then you don't get that back that you've withdrawn. It's that 500,000 is whatever you've contributed. Once you reach the 500,000, that's it.
Yeah, I think it's a no-brainer to use a tax-free savings account. Obviously, the amounts are capped, but you do get a real benefit, and the long-term benefits can be absolutely fantastic. Just lastly, and we have a minute left, it seems very complicated. And I see you've got a textbook here next to you with notes.
So this is all the tax legislation.
It is really complicated. If you are starting to build a wealth portfolio, whether it's within a retirement annuity, whether it's discretionary capital, it is important to take the tax implications into account. Many people phone me and say, listen, I've got a fixed deposit. Should I earn 8% or 7.5%? You need to take into account what the tax impact will be, because in many ways, if you subtract the tax, the real income will be a lot less than inflation, and not a lot of people, or not too many people, actually take that into account.
And you become poor by saving.
Yeah. Anyway, I bring us back to the point at the beginning, the more tax you pay, the more you've earned. And just make sure that you pay what you need to pay and not more. But Louis, Piet, thank you so much for your participation today. I think it was an excellent discussion, and I think many people will think, whoa, I need to go and see a tax professional. Thank you very much. This is the end of this session. Stay tuned. We have got a lot more to come.